I want to discuss the balance sheet strength of consumers and corporates. How does it look right now? Where is the trend going? And then also, are there areas where there's just excesses that we should be aware of?
Yeah, regulators don't like to bail out the same sectors twice. And I think this is important, and we talked a lot about this at the Secular Forum. The post-global financial crisis regulation has really set the stage for a lot of attractive asset allocation decisions even today. If you look at debt levels on a global basis, a lot of debt has found its way on the sovereign balance sheet. There's segments of the corporate arena, particularly some of the floating rate, lower quality credit markets, where you've seen leverage go up and go up quite significantly. The household balance sheet, though, has witnessed significant deleveraging.
Yeah.
A lot of that, again, is related to all this post-global financial crisis regulation on consumer lending, on mortgage lending. But you have a situation today where fundamentals are very, very strong in that sector, yet you've seen pretty aggressive growth in terms of leverage in other areas of the market. So, we think that this does set the stage for attractive opportunities. When you look even at relative growth within this opportunity set, you see a situation where, again, more aggressive corporate lending has grown almost exponentially since the global financial crisis. A very small sector just 15 years ago, now $3 trillion or so today, while again, asset-backed lending, consumer-related lending has been kept in check, and where credit quality is very, very strong. So again, a fairly straightforward and simple asset allocation decision. We're reflecting this across PIMCO, more traditional portfolios, public portfolios, private portfolios. We think looking out 5 years, there's going to be incredibly attractive areas to build a resilient, high-quality portfolio and avoid some of the froth and some of the excess that's developed in areas that made it through the GFC relatively unscathed and therefore has escaped some of that scrutiny.
Let's keep it on lending. And if you think about regulation, the regional bank challenges we've seen, they've created an opportunity for investors to step in where banks are. Can you further explain this dynamic and how the retrenchment of banks is creating opportunities?
Yeah, and I think there's at least two reasons for this. The first, what I just mentioned a moment ago, which is that banks were heavily regulated coming out of the global financial crisis. Aggressive lending from the banks caused a lot of the problems that needed to be dealt with. So we're still feeling the reverberations of some of that activity. And it's leading to banks either being less involved in markets they used to be quite involved in. And more recently, this aftershock coming from this significant increase in policy rates has led to further fragility across the regional banks. So this has created a little bit of volatility. With volatility, typically comes opportunity, and we're seeing a steady flow of assets coming from the regional banks. High quality assets, assets more appropriate for private strategies, and we expect this to continue.